Congratulations! You found the Pirls Stock Market Commentary for market week ending Friday, March 13th, 2015. Market breadth. With this past week's market decline, our bull-bear point and figure ratio dropped from 1.22 to 0.90, falling into bearish territory. The total count of securities in bullish or bearish patterns fell 1% to 2,937. The count of bearish stocks increased 16%, while the count of stocks in bullish patterns decreased 15%. The Pirls P&F Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the proprietary chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking the Membership tab, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 90 points for the 12th decline in 21 weeks. At a positive 107.72 points, it has fallen below the November 2014 top and continues below all 8 remaining tops above plus 100, as well as all 5 bottoms below minus 100 in the last 3 years. Market Gauge Volume Analysis. In this week's volume analysis, all indexes ended in neither accumulation nor distribution mode. In the last 2 weeks, the Nasdaq 100 Trust had 0 accumulation days and 0 distribution days. Of the other indexes, both the Diamonds Trust and the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. Momentum. In a Woody's uptrend declining for the week at minus 104.53, the CCI 20 daily now has 4 consecutive days below zero and is outside the plus or minus 50 range for a valid Woody's zero line reject signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 34 weeks ago, while the daily CCI 20 began a Woody's uptrend 4 weeks ago. With the CCI 20 weekly at 102.28, falling from last week, but remaining above our plus 100 exit point, we continue in the trade begun after the Friday 123 close, long zero line reject entry signal. We will continue following the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. 3 of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, networkers, and brokers continue in the top 5, with brokers now leading it. Oil continues in the bottom 5. Oil services has entered the top 5. REITs has left the bottom 5. Gold and silver continues in and now leads the bottom 5. Bearish, computer hardware continues in the bottom 5. Semis and S&P retail have left the top 5. Focus this week from Mark St. Cyr's blog Indeed, this time is different because it's far worse. The following are some of the highlights of the article. Investing isn't going to be so easy this time. Why? Let me be so bold to use the same meme touted by the likes of those who sold it. Because it truly is different this time. Without QE, not only is there no one buying, what's far, did I say far, worse is there's no one to sell to. What the Fed has accomplished, whether intentionally or merely complicit in the results, were to systematically exterminate the dreaded short sellers. Today, everybody is currently on one side of the market, and that side is long. Now it is being reported one HFT firm is suing another for egregious manipulation. You just can't make this stuff up. Nonetheless, what you can up is the level and lengths to which one HFT firm will pursue to have the advantage to provide liquidity quicker than its competitors because they're upping their game with the advent of lasers in an all-out arms race to see just who will be faster to the average investor's blood supply. Why? Easy. Lasers are faster than microwaves. And when the game is to view the other fellow's hand before they can blink, you win. Because trading is not about fair play. It's about winning. Just ask a company like Virtu, a HFT firm that's had only one, no, that's not a typo, losing trading day in 1,485 trading days and counting. Who knew legitimate ethical trading could be so awesome? What was once possibly the greatest buffer as to understand and take positions for or against irrational selling or buying behavior has disappeared. Within that group of displaced traders, in my opinion, is the one set you'll need more than anyone in a bull run going bad. Shorts who need to buy as to cover their positions. Remember that immortal line from Trading Places, June 1983, Paramount Pictures, when the Dukes were losing their fortune? Turn those machines back on. Will we need to do the exact opposite when the machines suddenly sell into an empty pit of buyers, as it's been documented by Nanex? Liquidity vanishes? So much for providing liquidity, when that liquidity is their own fortunes bleeding from the screens. Plugs will be argued, if not begged, to be pulled. And that's just the start of why this time it's different. Monetary policy on a global scale is now becoming unhinged, and carry trades associated within the currency markets are just beginning to show their distress. Today, the euro is not falling, it's plunging. China's economy is showing contraction. Central banks around the globe have cut and are still cutting interest rates. 24 to date, and that number is expected to grow because everywhere there was supposed to be growth is contracting, if not outright falling off a cliff. E.g., look to Australia as just the latest example. The Fed, as of today, has pulled the plug on QE and implied it's time to raise interest rates. All at a time the global economy is showing just how addicted it truly was to the Fed's QE policy of free money, along with near zero interest rates, leaving the Fed with the difficult choice of exactly which policy are they to enact. for both will have dramatically different results. One is to go back on all they've said, admitting they got everything wrong via the signaling that not only will interest rates not be raised, but in addition, the possibility for more QE is at the ready, sending critics of the Fed spiraling into a concerted effort demanding both an audit as well as hearings. Or they stick to their guns, signal the intent to raise rates, sending the global economy and markets into a tailspin of unraveling carry trades, currency wars, and quite possibly a full-blown currency-based Armageddon. Who knows what will transpire? But one thing is certain, this time is truly different. Thank you for tuning in for this week's Sand to Pearls Stock Market Commentary, featuring the proprietary Bull Bear P&F Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you're looking forward to a wonderful week coming up. Happy St. Patrick's Day to those of you who will be wearing green, and to the rest of you as well. And, as always, wishing you true success.